Good afternoon, everybody, and welcome to the Traders Group. This is your host, Gary Yemeski. It is Monday, March the 23rd, a little after 4 p.m. Eastern Standard Time. I want to welcome everybody on board, new as well as old. And as always, let's go ahead and get through the disclaimer real quick. This webinar is for educational purposes only. I'm not a licensed representative giving any kind of trading advice whatsoever. Options derivative trading does involve risk. So these webinars are designed to aid and educate you. Okay. How did everyone do this last week? For that matter, the last couple of weeks. It's been oh, you did good, Jose? Great, great. How about the rest of you? The rest of you do well as well? Do well as well? I don't know if that's a way to even say anything. It's been a difficult week, to say the least. It's been a difficult couple of weeks. As a matter of fact, today I got my butt royally handed to me. Trading the E-minis, it was the worst, choppiest day that I have traded in I don't know how long. And it was something I should have recognized early. I missed the actual move in the morning and then was upside down and trying to make it up, and that's not a good thing to do. There is no audio, or is it my connection? Have we not started yet? Jerry, it's you. You don't have an audio going, so let me type that in since you probably don't hear me. Oops, that was supposed to be to Jerry. Okay, Jerry, you should be able to hear me now. Jerry, type in that you can. Yes, no. I think you should be able to hear me. Okay, everybody else hear me? Okay, good, good. Yeah, this week was pretty rough. Pretty doggone rough. And today was just one choppy day. We were up 75. We were down to 40, up to 45, up to 60, down to 50, up to 55, down to 29. And then it was $500 million worth of equity to sell off within the last 5 minutes. And I watched tick charts when I trade the E-mini. Oh, my God, those things were flying like the fastest Christmas bulb lights that you've ever seen flicker. It was pretty crazy. Anyways, we ended down. I was really hoping we'd have an update today, only because it would have stopped the pattern that's been going on for the last couple of weeks of up and down and up and down and up and down. Especially since Yellen spoke, even as everybody was calling it, was a very dovish statement in regards to what her view is going to be moving forward in raising interest rates. A great choice of semantics. Everybody was looking for the word patience to be removed from her rhetoric, and she did. She said, no, we're no longer going to be patient, but that doesn't mean we won't be impatient, or that we will be impatient. So I thought it was an interesting choice of semantics. They were basically playing games and telling everybody the guessing game. So it's interesting, though, with this choppy week, if you look here at the Dow, you know, we're up 100, 150, we're down 150, 200. We're up 200, 250, we're down 100, 150. We're up 200, 250, we're down 150. We're up 200, and then today we're just kind of taking a breather. But interesting enough, you do see all 4 triggers indicating that we have turned the point, and we are on an upward trend, which is actually what's happened here over the last 1, 2, 3, 4, 5, 6, 7, 8 trading days. You could see if I put a trend line on here that we're in an upward movement. We have our hull turned over. John Person's pivot studies turned up. The MOBO has broken. on a 6-month chart, which is what this is, linear regression is pointing up, and the 49 is still above the 89. So all indications right now is that we're going to continue rising on all three indices. This is, of course, the S&P. You can see the exact same scenario. The NASDAQ is real interesting. Boy, we really gapped up after the Yellen speech and pulled back, and then we pulled back a little bit again on Friday. But again, all of the three indices are showing that we are in an upward pattern. We still have not put 2 days back-to-back of positive gains, but we'll see what happens this week. We do have some interesting economic data coming out, which I think will also kind of give a pulse to the Feds of where things are going, even though they've already said they're not going to be raising rates. But GDP is coming out on Friday, and that's going to be an interesting statistic to see how that speaks of the economy. Most analysts, hedge funds, big-name traders are still bullish in the market. They still say buy the dips if you are longer term. When I say longer term, for us derivatives option traders, it's probably more like buying a minimum of 3 months or longer. When I'm saying buy the dips, if you're going to be playing some of these great equities. And again, folks, remember, we always trade great stocks. That's the whole key to making money, is trade good stocks, companies that have good earnings. So I think that this would be a key statistics. Of course, you have jobless claims coming out on Thursday. You also have my alma mater, University of Michigan's Consumer Center report coming out on Friday, which they rate this as a mild movement marker, and it normally is, but it does affect the market. It gives a real sentiment of how the Americans feel about the economy. So the CPI is, of course, Tuesday. Durable goods is Wednesday. Jobless claims Thursday. The big one, GDP, Friday. So we do have some economic data coming out that's going to be kind of herky-jerky. So let's see if we can put together a couple of positive days back-to-back. And to reiterate once again, the market is in a choppy uptrend. Okay. The Dow is still only about 17 and a half times earnings, which is still not overbought, folks. Remember, I said this last year, you know, be careful about getting on the bandwagon of doom and gloom people that, you know, want to get you to start selling. The market is not overpriced. It's not overpriced till it's about 21, 22 times earnings, and it's only about 17 and a half. So there's plenty of room for growth, but it is going to be choppy moving forward. You hear about Herbalife? I guess they're investigating it again for being a Ponzi scheme. But I heard something, and I haven't been able to verify this and check it out yet. Wonder why I have this. Let me remove these drawings. I don't know why they were showing up. Oh, it's because it was on the S&P. Which is, I wanted to do this a little bit more often in the beginning, is really concentrate on the S&P and take a look at this particular chart on a 6-month basis, because it really gives you a pulse of kind of where we at versus all the three indices, and we more concentrate on this. This gives us more of an idea of where the market is. But I wanted to look at Herbalife. Herbalife is what, HRB, isn't that it? No, that's H&R Block. What is Herbalife? Can somebody help me out with the ticker on that? Somebody look it up. Speak quickly. Come on, Jose, you're pretty quick on the stick. Okay, thanks, Scott. Appreciate it. Not HIF. What did I? HLF, excuse me. somebody came in April, 55s, and bought a 10,000 position, I believe over the weekend or last Friday. So somebody's really bullish on Herbalife. Yet you also see a lot of short interest. Now they could be doing I don't know, a portion of that as a straddle. I don't know. But really interesting about what's going on with Herbalife. Anybody trade the VIX, the VXX from my last week's webinar? I put it on the short side, the 27s. Anybody jump on that? I did. I bought those 27s. But I bought the weeklies instead of the Aprils. Dollar cost averaged to 44 cents. And then I sold them on Friday for $1.68. So ended up with about 60 contracts. So it was a nice play. I do believe oil, again, going back to maybe buying longer term. I don't know if in the near term everybody is saying oil is going to go below $40 a barrel. And I believe that to be true, folks, because every single supplier or every country out there is not cutting back on supply, period. They've adamantly said there's only one country, I think, that's vacillating, and I don't hold me to this, but I believe it's Libya. They don't know if they're going to increase or decrease, and that may have an impact, of course, but not compared to the rest of the OPEC and our shale providers or shale producers and so forth. So I do believe the great companies, ConocoPhillips, Exxon, all of these other great oil companies will rebound. Just don't know when. So I think that tradition, and this is, of course, the season that oil normally goes up. We all know that from our best choice. It still continues in a downward trend. We have a signal for tomorrow that it's going to continue to go down further. It's in a classic pattern of, well, this isn't a lower high, but we do have lower lows, which means this is probably going to continue to go further. But you can definitely see a trend line that's continuing to go south. But for one of the things that people are suggesting is if you want to buy some time, not the typical May expiration, but further out in time, perhaps do a bull call to limit your cost of getting into these positions, because oil, I do believe, is going to rebound. There is a lot of option support level for oil at the $42, $43 a barrel level. So watch that for resistance. If it busts through 42, 43, we're looking for oil probably to go below 40. Where did oil finish up? Well, had a little rally today, up 77 cents. What other tidbits do I have for you? It seems like biotech, and anything in biotech and all the companies, BIBB and some of the other, Amgen and so forth, that sometimes some of us like to trade. Some people are calling it a bubble. I don't know if that's true, but according to an article I read, 90% of all drugs that are in the pipeline are in phase 1 and 2 of their trials, which is really early stages. And evidently they're not considered to be quote-unquote blockbuster drugs. So if you're thinking about that industry, because a lot of people like to play it, there's big money when they make big moves. Just be aware that that's what's going on, and you perhaps want to wait for things to finally pull back before they start going forward. What other things did I hear today? Ted Cruz announced presidential bid. So he's going to throw his hat in the ring. New York Senator Chuck, I think it's Schumer, is calling for an investigation into lumber liquidators as well, because there's just been enough screaming about their formaldehyde in their wood. So we'll see what happens there. I'll be honest with you folks, I don't have a lot of trades to look at today. So This will probably be one of the shorter traders groups that we have. I will go over some things, though, that I think are relative for us to look at this week. One of the companies that's coming out with earnings this week is Red Hat. And they are just strong as onions. Seasonally, folks, 60%. However, let me bring this in. Expect Red Hat to beat analysts' estimates on Wednesday. And he gives a whole litany of explanation why. I'm not going to belabor it now, but do read through it. And I believe there's a tremendous amount of strength in how the analysis of this person, Quantified Alpha, did this analysis on Red Hat. That's one thing. The other is Earnings Whisper. How do the analysts feel about Red Hat? And there are 17 strong buy. The target price, its members' target price is 75, but most of the analysts are between 75 and 80, if you look at most of these. And they are coming out with their earnings this week. On the 25th, after market close. So I think that's a potential play. Last time I looked, the 72.5s were going for $1.60. I don't know what they are today. This is one of the reasons that I like it. There's 9,717 open interest on the Aprils at the 72.5. It really didn't fluctuate at all. At a 3-cent move. And I like this chart. You got a breakout of the MOBO, you have a PPS breakout, a hull turned over, and a MOBO breakout. Just a little bit of uncertainty today because of the market uncertainty on Friday as well as today. But I still believe this is a play, and so therefore I listed it. Okay, Sonic. Anybody eat at Sonic? I don't eat fast food. Evidently, they're a very well-run company, though. They're coming out with earnings tomorrow after market. Last time I analyzed it, I was looking at the April 35s at $1.10. It's a 90% historical probability. I didn't like this, even though this says 100% with a $13 move. And you could say, well, 2010, 2009, and 2008 are kind of skewing all the rest of the years. There isn't a lot of percentage consistency on that. And I've learned over the past, you kind of take that stuff for granted. But I don't like the end date because you could say to yourself, all right, has it already moved 13%? Is this run over with an end date of 320? First thing I'm going to do is I'm going to go look at this pattern, which it really only has a $3 spread between the upper and the bottom line, which is a 10%. It's 10% on a $30 stock. I'd like to have it a little bit bigger, but not a lot of volatility, folks. However, when you go to a 2-year on this chart, I like the price and earnings consistency of 95 and 92.9 respectively. So the company is doing well, and earnings are supporting price movement. So I like Sonic. I didn't see what Sonic was doing as far as the analysts, what they think. Okay, 6 strong buy, 3 hold, 2 strong sell. So basically 5 against 6, almost a 50-50. From things that I've read about it, I do like it, so I listed it. What's next? PVH, interesting. did some analysis on this. You could either do a bull put on this and get a credit of $1.55 when I looked at it, or you could just buy it outright at April 110s when I did the analysis. Now let's see how it moved today. First, let's take a look at Best Choice and see what Best Choice says. Now, according to this, from 3.8 to 3.28, and when are earnings for this company? There's Sonic aftermarket tomorrow. PVH is Wednesday aftermarket. Okay, Wednesday aftermarket. So how did they trade today? First thing, good. That's another thing. I really liked this pattern breakout. And in a mixed day, they're up $1.33. One of my concerns is this high IV ranking of nearly at the 85, 86 percentile of its last year's implied volatility, last 252 days. So with that in mind, you need to understand or realize or be cognizant and aware of that these options are overpriced accordingly. There's two things I like with Thinkorswim, and that's probability of in the money and probability of touching. These are important statistics to know if you're bullish or bearish. When I did the math for this potential move, 13%, I may have did best profit per trade to see if there was something that was started a little bit later. There's an 80% move. What did I list it as? Listed it at 88.9. I must have saw another move in there. Nope, I guess I didn't. There it is. 88.89 from 3.8 to 3.28. Some big years. It moved pretty big the years before. So in lieu of that, there's not a lot of open interest to get a credit on this. And I don't know, this moved $1.33, and I believe I think I did the 190s. I looked at this, 195s, excuse me. So it's a credit of $1.27. Risk reward, it's pretty good. It's pretty good. If you go to the analysis tab for PVH, and we're expecting, what did I say for a strike price on this? The 110s. They're coming out with earnings Wednesday after market, right? Wednesday before market. Why did I say before market? Oh, I wonder why this is starting to freeze up for me. My apologies. Toss is frozen. Maybe it stopped. Okay, hold on. Nope. I want you guys to learn this, though. A really great tool. I spent some time with a broker when I was in a position last week, only because I wanted to know how my position would be affected if I held it for another day. And then he showed me the technique, and I went, wow, that's pretty cool. I like that. And I think you guys will as well. This is what I dealt with this afternoon, or today, trading that mess. And then there was $500 million of securities to sell off at the end of the day, and that's what happened. Very difficult market to trade. I should have known better. I missed the move. This was the move right here. In the morning, you can see the time frame here. Market opened up, right? This is the 5-minute range. As soon as it busted that 5-minute range, that was the move from 102 to 107. Solid 5 points. Anyways, we were talking about PVH. We know they're coming out on the 25th. It's aftermarket. I don't know why I have it listed before market. I need to change that. Okay. We're thinking about, once again, the 110 strike based on their average percent move historically. You can see the IV. What's today? Is this got today's? Yeah, this is today's date. Let's assume that we're buying the 110s for $1.70. Be on add simulated trade, and then you open up the price slices. They're automatic. You can change them and so forth. This is just based on a 10% move. In other words, if it goes up to $114.15, we can adjust this, of course. And with PVH, if you look at the sweet spot between the 50, the middle line, 50% of price movement, and the top line, 90% of price movement, right in here at about 110, between the 108.90, 110. And based on a 13% move, and this says $8.37. Well, let's just say $8 plus 103 puts us at 111, correct? Okay. So we're assuming we're buying this. All you do is change this date to, let's say, the day after the 26th. They're coming out on the 25th. And so if it moves to $114, for $170, you'd make $462, which is about what? 150% on your money? There's your profit and loss. And of course, that's if it moves there. We could say, well, what if it, if it moves 9%? I said it just moves to 111. Are you still making money? So this is a great tool, folks. You could say, I, of course, historically expected to move 13, but remember, that's in that whole time frame of 20 days. It's not going to do that move overnight. It's not going to move 13% overnight. But we do expect a pop, right? And even though best choice, a lot of people would just go based and granted, okay, it's moving 13%. I'm going to pick a strike price that's reasonably priced under 3% and, below the top line and run with it, which is a simplistic way to look at this. I go a step further, of course, because this is my money. I'm going to go to a 5-year chart. Oh, by the way, I did the fib retracements, and so this is really good to look at this. you can see the 61.8, which is usually a very typical resistance level. Then you have the 50%, the 38.2, and the 23. Between the 38.2 and the 50% retracement from its last high in the last 6 months would put you right at about 110. So 111.48, there will be potential resistance if it does pop that high. But what did it do last year? What did it do the year before? All I do is go to a 5-year chart, wherever those phones are, that I'm going to drag my mouse so it will visually allow me to be able to see what actually happened. Okay, so on that day of March the 25th, estimate was $1.43. It came out at $1.43, but look what it did the next day. It popped. That's what I need to know. I'm not going to be as anal to look at exactly how much. Sometimes I did, but what did it do the year before? Year before, I was a loser. So I got a 50-50 on that one. What about the year before that? Year before that, well, it kind of moved down, but it ended up going up eventually, because that was the closing price of 89.81, finally ran to 90.77, or as high as a 92, so not a real big move. But it did have an upward movement, which is what I needed to know. Now remember, when I get down to this area, this stock price is different. Here once again, well, that's about what we just did. Yeah, I'm sorry, that's what we just did. Okay, there we do have a gap up. So we kind of have a mixed signal, but we are expecting, based on history as well, to have a strong pop-up. Where does this stand historically in its price movement? Well, that's what I like to see, down there between, in the lower areas of its historical price movement. Kind of follows that composite, or we're looking for a pop-up. What does Earnings Whisper say about him, or the analysts? Analysts are pretty strong, with an 8 strong buy and 1 moderate buy. So I saw 2 ways to trade this if I was going to trade this. Was to buy the 110 straight outs. I think it's reasonably priced at $1.70. Or a credit spread for $1.27. And basically it's saying by the 26th, well, let's call it, that's Thursday. What about Friday? Okay. I get a $1.27 credit. That's what I'm going to take in, $127. By the end of the week, if the stock closes at $111, I'll be able to keep around $91 of that. And on it costs $500 because that's the minimum requirement for a $5 strike increment. So $91 divided into 500, well, we know 100 would be a 10%. So that's about an 8% move in 1 week. That's not bad, folks. That's not bad at all. That's a good risk reward. So see how great this tool is? I mean, I used it for the VIX on Thursday to see where it could approximately go to when I was short the 27 on the weekly. This was after Yellen's speech in the market rock and rolled, of course. So it's a really, really useful tool that helps you analyze risk reward. Does anybody have any questions on how I do this or how you can do this? Let me go through another scenario. Let's take another stock. GameStop is coming out on the 26th after market. What does GameStop do? One of my concerns is right up here. You can see how this thing has been screaming. Just rock and roll up. That move there. Basically almost filled the gap. Hasn't quite though, because the low of this was 42.55. The high of that was 42.28. Almost filled the gap. Almost. This thing looks like on a 2-year basis. Now, price consistency stinks, but earnings consistency isn't too bad. It's a 90% probability, pretty good percentage consistency, which is what I look for in the historical seasonal charts. And this does take it from about, this last Friday, thereabouts, Thursday, up until the beginning of April. The only concern I have is it's sitting way up here. But if it does well, what does Earnings Whisper say about GME? Analysts are real strong about it. Evidently, there was a huge demand for some video sales over the last 2-3 months. You don't know how to use those? All right, well, I'm going to go through another example here with GME, okay? So let's say you find a stock you're looking to trade, like, let's say, GME. We know earnings are coming out. We know it's a historical 90% move, or 90% historical percentage probability move, about a 12.45% average move, which is really consistent with what I see historically percentage-wise. Okay, 12.45 earnings trade. Let's first find out when are they coming out with earnings. Okay, they're coming out Thursday after market. So Thursday after market. So now let's go to the Analyze tab. Type in GME. Okay, 41.34 is where the stock is at right now. And I'm going to multiply that by what I historically expect the stock to move. Gives me a target price of $46.48. Where does that fit into a linear regression chart, or does it? Sorry, I don't have the chart that I normally use. Let me load that up. There. Let's go to a 6-month chart. Well, it's definitely broke out. It hasn't quite reached, like I say, filling the gap, which is at 43. The last high was 44. I don't know. I don't have it. This was a difficult stock to try to do Fibonacci's on because of this erratic pattern. And there's all sorts of extensions I could do. Typically when you do an extension to see how far more can a stock move, because it's at the top of linear regression, we can't use the middle of linear regression to the top and say, okay, where's our sweet spot? Well, it's not there. Let's say go to a longer time frame. Well, a year, the top of linear regression at 90% is at 44. Well, I expect the stock to potentially move to 46. I have a 1-month standard deviation of $5.56. If I'm choosing April, I have a month's time. So I'd add that $5.56 to the stock price of $41.34, and that puts me over $46, puts me real close to this. So those two are kind of confirming that's where a stock could go to based on seasonality. I also would go to the trade tab to see what the IV plus would be for an April. Well, that's $4.28 over here on the right. 4.28, that puts me almost at 46, not quite. 45 and change, 45.84. So being conservative, I'd want to be underneath those three potential target prices. Once again, Fibonacci really, even if I did from a year's chart for a retracement from its last yearly high to its last low, 43 is at the 78, and of course at 100% it's at the 46. So let's go back to the analysis tab. Well, historically, what did I expect this thing to do? Target price 46.01. How much did it move? It went up 42 cents. So this is a little bit different because I had a lower closing price when I did the statistics. IV target 45.42. 1 month standard deviation 46.90 or $46.70. So I like the 43s being way underneath those three. Right there at $1.16. I don't know if that's what it costs today. Yeah, $1.20. I have a delta of over 20 at 38. Probability of touching of 71%. Probability of in the money 33.64. But remember, folks, this is not taking into consideration the quote-unquote known event versus unknown. We know that earnings are coming out. We know that historically it has a 90% probability move. We know that historically it could possibly go up almost 12%. So this statistic here is only taking in the Greeks and expiration time. That's all it's taking in, the current open interest and volume. Those are the statistics that are being incorporated in order to find that 33.64% of probability being in the money. Okay, so let's just say it's $1.20. Jose, follow me, and the rest of you follow me. Okay, so I want to know what's my risk reward on this. I go to my analysis tab. I've already got GME in there. It's defaultly setting for today's date. I'm going to go to the strike price of 43. I'm going to buy that for $1.20. So I expect it to go to about $46. So let's, a 10% move ought to defaultly puts it to 45.47. So I'm choosing the 43. I'm choosing underneath a potential 10% move. And all statistics are telling me from IV plus to 1 month standard deviation to historical percentage move that it's going to go above 45 bucks. That's, again, I'm trying to stack odds and probability in my favor. All right, so all I did is click that as if I'm buying it. Remember, you're on a simulated trade under the analysis tab. Just open up the price slices. It'll look like this. Just click that and open it up. These will defaultly open up. You can add and delete slices, but we're not going to get into that now. So we know earnings are coming out the 26th after market. I've already got it set to the 27th, the day after, which is, of course, Friday, because they're coming out after market on the 26th. So we're assuming a pop, if it goes up to $45.47, you've made $208. It doesn't move at all, which is completely unlikely. It's not going to happen. You lost $17.24. If it goes down 10%, you lose $104 by Friday. But here, what if it goes up? What typically happens, folks, to stocks that pop after earnings? They go up, right? And all of us people that have positioned ourselves prior to that trade, we're expecting a pop. What are we doing with our money? Well, we're taking our profits. Some of us will scale out a little bit, leave some in if we think things are going to run a while. Most of us are just taking our money. Say, thank you very much. Mother market, give me another trade. But what if you chose to hold it? Remember, these are Aprils we're buying. This is only March 26th. So what's cool is you can wind this clock forward. and say, well, what if I waited to, it's going to say expiration Friday. I don't think I would, and I don't think any of us would, but what would my profit be? Be 127 bucks. That's it. If that's all it moved. So what we can do is you can find out where is your break-even point. If the 27th on Friday gives me 208, well, what if I held it till Monday and the market started to really go on the 30th? Well, it's gone down. So now we know what to do. Now if it moves 11%, there's 229. You can change that percentage by clicking these blue arrows up or down. So it's a way to review risk reward though. Okay? Let's go through another one. SIG. Anybody know who SIG is? Signet Jewelers. Found this one on Best Choice. SIG. Signet Jewelers. 100%. 13.77% move. Where is it sitting at? Well, this is a one-year chart. It's kind of coming off the bottom of linear regression. They're pointing upwards, which is good. 6 months, same thing. Linear regression is all pointing upwards. Bottomed out, pulling up, sitting right about the middle of its extreme, which means it has a little ways to go. What did it do today? Oh boy. See, when I analyzed it, there it was. It popped up real strong today. So when is SIG Jewelers coming out with earnings? They are also coming out before market on the 26th, on Thursday. Do they have any volume to make it worthwhile our interest to even look at? Yeah, somebody came out here and bought 1,000. When I analyzed this, there was an even 1,000 contracts sitting at the 145. Way too far of a stretch, folks. Way too far. May, there's really nothing going on. I believe what I was looking at for SIG was the 130s for $2.35. That may be out of my price range now, because even that was kind of expensive on $128. Well, no, it wasn't that expensive. So now we're looking at 370. $3.7 divided by 128.66. Oops. 3.7 divided. Well, it's only a 2.8 premium. Still decent. Still decent. Cash standpoint, you can't maybe buy as many contracts if you're on a limited amount of money that you spend per transaction, which if you're not, you should be. You know, I used to teach, well, you know, put someplace around 5% of your trading capital on any given trade. Never have more than 50% of your trading capital out at the market at any given time in case the law of averages catches up to you and you get blown out. At least you can lick your wounds, find out what you did wrong, and you still have trading capital to get back into the market instead of blowing up your whole account and having to start all over again, which if anybody who's been trading for any length of time, we've all done that. So 370 is kind of expensive. Let's see what that, first of all, let's see what the analysts think about SIG. Wow, 9 strong buy. 140 to $150 target prices. 150 was way back in November, though. And so is this one. So these are kind of obsolete. But still, out of 10 analysts, 9 are saying strong buy. This company's doing something right. So let's say we bought the, let's clear out GameStop. We bought the SIG. 370s are coming out with earnings. after market, or I'm sorry, before market on Thursday. So we would kind of say, okay, Thursday, if at the end of the day the stock closes, and our target, we have an $8.50, $8, let's just say 8 here in the IV and round things down to 128, puts me to 136 potential target with a standard 1 month standard deviation is $11. $11 puts me at 139 with best choice, 13%. Puts me 144. Wow. But nice looking chart, huh, folks? These are kind of trades you want to see. This is just taking it from the low to the high to the last low to see where extension could potentially go to in Fibonacci. What a nice looking chart. You want to be conservative? Take a look at the 132s. You could be more aggressive and take a look at the 135s. I mean, $11 plus, that puts you at 139. $8.50 plus 128, that puts you about 137. 13%, like we already said, puts you at 144. So you could, if you wanted, go to the 135s. Not a lot of open interest, folks. That'd be really concerned to me. Only 109 contracts out there. They need liquidity. So $3.70. Let's say it does do 10%. 10% puts me at 141. Spend $370. If it moves to 141 by Friday, you've made $838. If it only moves to $136 and we chose the 130s, we still make $412. It's 100% on your money, folks. Good risk reward. Okay? Real good risk reward. So, you could defaultly, you could just leave it at the default, but I don't like to do that. I like to say, well, what does the IV plus tell me? What does the 1 month standard deviation tell me? What does the historical best choice tell me? Now I have 3 statistics to use to, even if I wanted to average them, but they're all putting me above 135. Now, let's say we got rid of that and say we bought the 135s instead. 1 contract. That's all I would risk with only 109 liquidity, maybe 2. If this happens by the end of close on Thursday, and it just rock and rolls and pops up, you make $615 on a $190 investment. Folks, there's your 3 bangers, Sonny Decker would like to say, if it moves to 141 at a 10% move. It's a big move, folks. What if it only moved to 135? Did a 5% move? 202, you still made 100% on your money. Starting to get the idea how to do this? It's a real good tool to be able to analyze risk reward. Okay. So I went through the 3 different earnings trades. Couple of seasonals. Wyndham Worldwide Corporation is 100%. Historical move starting about now. Nice looking track upwards. Sitting at about the 65% extreme though. 1 year it's at the 88% extreme. And 3 month at the 64, so it's kind of in the middle. but nice historical chart. If you look at just this area, you could say that's using best rating of whole zone. If you move it to best profit per trade and highlight that whole area, first thing I look for is it the same win percentage? Does it have legs to run longer, which will tell me I could look at May for an expiration instead of April. I let go, it turns green. Okay, there's 1 year that it missed. Which year was that? 2014. Yeah, 2014 it did. If I would have bought in here and sold down here, it was a real herky-jerky year. So that kind of tells me no. If every year lined up where it ran further and it increased my percentage profit, well, that would change my interest in which spot or which month I'd be looking at for expiration. Best rating of whole zone gives me that same 9.3% between now and the beginning of April. Okay. So 9.3%. Any interest on win? And a lot of people loading up right here at the hundreds, but it's a 6 delta. I think those are some people that are probably selling. You definitely have some people here doing some bull put spreads. You can see that between the 90 and the 85. Get 77-cent credit on a $5 move, about 7%, if you were able to take all that in. 9.3% is what we historically expect. 91.41. Puts me at $99.91. Wow. What is this? $3.41? Nah, that puts me at about 95. What does our 1 month standard deviation give us? $5. 5 plus 9. Again, so I would be looking at something around the, if they had a 92.50, do they have a 92.50? Yeah, they do. There it is. Not a lot of interest though, folks. But then you open up May. May's a different ball of wax, isn't it? 2,226. So I'd probably buy some time. Spend a little bit more money, $2.55. But my delta's 45 versus 40. Only got 100 contracts here. I have 393 here plus a lot of time, which means more people add up if it continues to move in that direction. Courtesy one of our other members, RS, initials of RS. Oops. That's not what I want to do. Sorry. This is courtesy of one of our members. Disney, which we all know smoked earnings back here that we all made a lot of money on in February. Well, it's also a historical move right now of 90%. Not a great rating, but it is a 90% historical move. It's on a real nice track, just running straight on up, continues to move. What did it do today? Looks like a pullback. Maybe I'll play the pullback, wait for it to pull back. If it pulls back to the 20, be great. It's probably what I want to be able to take advantage of it. That's what I like to do, is fade the move. Wait for the pullback. You know, if things are going down, I'm going to buy a call if everything is telling me it's going up, or vice versa. Okay? If things are coming down, then I'll wait for it to pull up and then fade the move and buy a put. It's the same concept, just in two different directions. So historically, we have a 90% probability between now and the 1st, but if you go to best profit per trade and say, well, does it run all the way up into May that way? Sure enough, it does. Runs all the way into May. So there's a lot of excitement and open interest on Disney for April, as well as in May. There's 10,000 contracts in May, and that's probably what I'd be looking at for 233. On a $108 stock, folks, that's a good buy. At the 110, it's only $1.50 away. You could stretch a little bit and only pay 88 cents for the 115s. Oops, these were old ones, weren't they? So this is how you would do this, just so you could see. In other words, it just exploded and it continues to go up. So where is it going to go? Go to your Fibonacci extensions. Go from the last low to the high to the low. And so there's your 110 at 100%. 115 is right at 161.8. Magic golden number by Leonardo Fibonacci. So stretching to the 115s is stretching it right out here. It's probably why I wouldn't stretch it that far. I'm just more conservative and I play it closer to the money. Last one, gosh, I wasn't going to talk this long, but I guess I did. Once again, courtesy of one of our members, STX is a move right now. Only concern I have with this is the end date of 323. It is 100% move historically, but because it's been so beat down and it's just started its crawl back up, I'd probably still wait for a pullback a little bit more because I have a 75% probability it's going to go down again tomorrow. But I do have a MAC crossing. Can you see that down here? Good sign. Way oversold, starting to pull up. Classic moving average convergence divergence. So linear regression is pointing upwards. It's oversold, starting to pull up. Does have a historical precedence of 100% probability. So I'd still use that 8.52 even though these dates are off. It's just the move is starting later this year, that's all. So 8.52. $55.85 times, puts me a target of 60. That does not quite coincide with IV Plus, which is only $3 and change, $3.34. Well, puts me at 59. No, it actually puts me at about, I'm sorry, it puts me at about 60. It does put me at about 60. Standard deviation is $4.83 plus 55 definitely puts me at 60. So I would probably be looking at the 57.5 for 89 cents where I've got good open interest. How would that stack up on risk reward? STX, April, 57.5 for 89 cents. It gives you the mark. Well, actually gives you the ask. For 89 cents, let's say I bought 10 of those for $890. Spent $890. I don't expect that to make that move to $61 at a 10%. Let's just say it's $59.07. Well, let's do $60.32. $60.88. I like that. 9% move. And let's say it does this by 2 weeks from today. So I stay in this trade for 2 weeks, giving it enough time to be able to move. Seagate Technology is a great company. Great company. Buy 10 contracts, spend $890. The move takes me maybe a couple of weeks from today. Actually, that's 3 weeks from today. let's do a couple. Well, 3 weeks from today, I make $2,492. Not bad for an $890 investment. If it happens sooner, I make $2,608 if it happens in a couple of weeks. So there's how I analyze trade, folks. All right, 509, give me some stocks that you want me to analyze. Speak now and forever hold your peace, or forever Apple. Apple historically kind of has done quite a nice run. It's ran up, it's pulled back, kind of consolidating right now, a little bit of a doji today. Still have a downturn MAC, and it's not in the oversold area. There's my extensions for Apple. Don, or I'm sorry, who was the last person? Yeah, Don. So if you were to, Apple is in a nice, I like this chart. I really like this chart. If I was going to do Apple, it'd be probably a decent day to do it, as long as I'd open the market tomorrow and it's kind of a froggy day and the market wants to go back up. These are my targets of what I would choose. Let's take a look at another one, SNDC. SanDisk. What did I do wrong? Is it SanDisk, Don? Maybe you typed it wrong. I don't have SNDK, maybe? Is that what you were thinking of? SNDK, not SNDC? If so, you got a 90% probability of it going down tomorrow. It's on its uptrend. I would wait for it to break the 200 perhaps. From a seasonal standpoint, SanDisk is an 80% probability based on best rating a whole zone, best profit. 90% probability between now and April 8th. So that's not a bad looking move. What kind of volume? SanDisk is a great company. Oh yeah, I've already done this, and I think this is another one. Yeah, it pulled back today, so it's still kind of on its run upwards. The 50% Fibonacci retracement from its last 6-month high is at $90.47. Historical move of 10%. Wow. 10% puts me at 90, what was that, about $93, $94. Could I stretch to the 90s? That would be kind of stretching it, wouldn't it? Nah, 90, right at the 50%. Yep, right at the 50%. So I would stretch to the 90s. Lots of open interest and volume. What would that look like from a profit standpoint, a risk-reward standpoint? Buy the 90s for $1.79. Let's say it makes the move. Well, if it makes it by, you can see here, I'm going to walk this forward and you watch the profit loss. This is assuming it moves to $94. Let's bring that down to 92 at 38. We're buying the 90s. This is a potential $7.40 move, so now let's move it to, oops, that's not what I wanted to do. Move it to 93. That's what I wanted to do. All right. So if it moves, today's date. Let's assume that it moves let's say by this Friday, 345. Next Monday, 323. Next Tuesday, 316. So it would have to move pretty doggone fast. Otherwise, you can see how the decaying asset just starts whittling away any of the profit. So you got a 1 week window of time based on choosing the 90. So you really would have to go closer to the money. That's how this analysis tool helps you. You'd have to pay a little bit more. And assuming, again, it moves to $93, a 9% move, which from everything it says IV plus historical, it could. This is by the 13th. 2 weeks from today, you make $366 for spending $268. So honestly, this is not a real good risk reward for me. I mean, if it moved there in a week, great. Do I expect it to do that? I don't think it's moving that fast. It could. It could. But it would have to move that fast in order for the risk reward to be there. Okay. Any other stocks you'd like me to go over real quick? Going once, going twice. Okay. Thanks for attending, everybody. I wish everybody good luck this week in trading. And as always, be smart and remember when to exit your trades.